Hello, everyone, and welcome to our first edition of Zooming In on Collaborative Digital Intelligence. I am Rhea Kalaf, Director of Collaborative Research and Partnerships for FINML, an academic member of IVADO, and I'm very happy to be here with you today to moderate this session, and thank you for being with us. A few mentions to start. Time is very precious today as the presentations are back-to-back, so I'll indicate when there are 2 minutes left or when for the last question. For questions, you'll notice in the chat that should appear on the right side of the screen, there's a chat question and poll tab. So please use the question tab so I don't miss any questions and I can read them to the to the people presenting. So there's no direct audio interaction with the platform. The only way to interact is through the chat. So that's the only way to leave your questions. And presentations will be recorded. So if you ever hesitate between two presentations, you could participate and you can always review them later. So today's presentation will be on digital asset market structure and liquidity modeling. We have with us Austin Hubbell, who's CEO and co-founder of Consilium Crypto. Consilium Crypto is a big data company developing institutional-grade investics and liquidity access tools for the digital asset markets, helping funds find alpha and place large orders efficiently in times of thin liquidity. With a background in software development and machine learning, Austin brings a skill set balanced between technology and business. We also have Fabian Bastin, who's a full professor at the Department of Computer Science and Operations Research at the University of Montreal. He holds a PhD in applied mathematics from Belgium and is affiliated with Centralized, IVADO, and FINML. His research interests cover nonlinear and stochastic optimization, statistical estimation, and simulation. So I'm very excited to hear your presentation, and I'll leave it to you, Austin and Fabian, to start the presentation. Thank you.
Thanks, Rhea. Hello, everyone. I'm Austin Hubbell, one of the co-founders of Consilium Crypto. Before I get started, just a reminder to everyone that Consilium Crypto research is for informational purpose only, and this is not financial advice. Today, I'll be going through a brief presentation on Consilium, crypto market structure, and liquidity in digital asset markets. This will be followed by Professor Fabian Bastin from UDM, who will present some of the research we've collaborated on concerning liquidity modeling in crypto markets. To start, a few words about Consilium. The company's activities can be broken down into three components. The first is to aggregate and analyze digital asset data at a global scale. Without quality information, nothing else works. The second is to leverage the scale and granularity of this data to train machine learning models to learn patterns of market behavior. Finally, these models are used to power trading technology and strategies across different exchanges, assets, and timescales. Just to give you a brief idea of the scale we deal with, Consilium captures and analyzes more transactions per month than the London, Toronto, and Hong Kong stock exchanges all combined. That's over 1 billion trades per month. Now we'll move on to a high-level overview of crypto market structure. The digital asset markets present a number of challenges for quant traders. In contrast to equities, there are hundreds of exchanges and trading venues around the globe where digital assets are traded. These markets are very fragmented, both in terms of information and liquidity. Crypto markets are notorious for high volatility and instability, resulting in frequent outlier events. These are 24/7 markets, with most exchanges operating using third-party software running in the cloud. Outages, connection issues, and unstable APIs are still common today. Even Coinbase crashes when prices spike. Finally, the growing institutionalization of crypto brings more competition for traders and ultimately leads to a technology arms race in the markets. Keep in mind, crypto is a global market with exchanges in countries all over the world. These are just a few examples of the exchanges we cover. There are two main categories of digital asset exchanges: centralized and decentralized. Both act as software platforms that facilitate trading of digital assets. However, there are a few key differences. The most significant difference is how the exchange handles user funds, with centralized exchanges typically holding the private keys that control all assets on the exchange. In contrast, decentralized exchanges act as peer-to-peer trading facilitators, where users retain complete control over their funds throughout the trading process. For the purposes of today's presentation, we will focus only on centralized exchanges. Let's take a look at an example of how a user would interact with a centralized crypto exchange. The first step is to deposit funds onto the exchange. Typically, this is done by initiating a transfer from the user's wallet to the exchange's wallet address. Settlement of funds is done on the blockchain, peer-to-peer between the user and the exchange. After funds settle on the exchange wallet, the user can begin trading. Almost all centralized exchanges offer limit order book markets, which behave similarly to most traditional exchanges. Users can post limit orders and market orders, as well as any other advanced order types supported by the exchange. Once the user is finished with their trading activities, they can request to withdraw their funds from the exchange back to the user-controlled wallet. At this point, the exchange initiates a transaction from their wallet back to the user's wallet using the blockchain as a settlement layer. After settlement, the funds are now back in the control of the user and cannot be moved without the user's private key. Each step in this process carries risks, primarily for the user and not the exchange. So why does the centralized exchange model work so well in traditional finance? The answer is trust, track record, and regulation. Most traditional exchanges have been around for decades, are highly regulated environments, and operate profitably. However, the level of regulation and trust in crypto exchanges is still very low, and the economics are unclear. Now let's take a brief look at an example trading strategy to show how liquidity and market impact can affect performance. In order to gauge slippage and liquidity in the markets, we ran two different backtests. Both backtests are for the same strategy using the same buy and sell signals. The only difference is that one backtest is done using trade data, which doesn't account for liquidity, and the other is done using order book data, which does account for liquidity. All data was collected directly from the Coinbase Pro exchange, widely considered one of the most popular and trustworthy crypto exchanges in the world. During this example, there are two main questions we're looking to answer. Number one, how much does market impact affect strategy performance in digital asset markets? And number two, is there any validity to trade data backtests in these markets? For the example, we used roughly 3 months of exchange data. The open, high, low, close data was sampled from raw transactions using standard methods, and the order book snapshots were sampled from raw order book updates, consisting of a maximum of 1,000 price levels on either side of the book. The example assumes a trade size of $100,000 on the Bitcoin market on Coinbase. These are the equity curves generated from the two backtests, one using trade data in orange and the other using order book snapshots in blue. Based on only the candlestick backtest, you would have expected a return of about 83% for this strategy. However, when including liquidity information using order book data, the expected return is only about 7%. That's a loss of 76% due to just slippage and market impact. We repeated this process with a few other order sizes, and similar behavior can be seen. At this point, two things start to become clear. First, slippage is a big issue when backtesting, even at small trade sizes. And second, this is not a phenomenon that is unique to smaller, lesser-known digital assets. In order to reduce losses from slippage and market impact, Consilium has developed a liquidity routing system that optimizes order placement across many exchanges simultaneously. It allows for large trades to be broken down intelligently across exchanges in order to achieve a better price when trading large sums of capital. To enhance our execution algorithm offerings, Consilium partnered with IVADO and FinML for multiple projects in the area of liquidity modeling. Now I'll pass the mic over to Professor Bastin from UDM, who will speak about some of the research conducted during our collaboration.
So thank you, Austin. So let me share my screen. Okay. So as Austin has said, we'll briefly present some elements of the research that we are currently pursuing. So the slides will be in French, but I will speak in English. So basically, the outline is that we collaborate between Université de Montréal and Consilium Crypto. By the collaboration is directed by FinML. So this is the project that will collaborate between universities through Canada and FinTech. And I would like to say a special thanks to MyTax, because MyTax provides funding for this research. And the slides will be mainly done on the work done by Jean-Francis Carignan and Eric Fleiderer. So, and the main topics that I will present are due to Jean-Francis. And so this is not myself, this is really Jean-Francis' work. So thanks to him. And I will mainly speak about the digital asset markets and limited order books. So briefly, as Austin said, we consider exchanges on traditional markets, and except that we consider digital assets. And we can consider three types of orders. The three main types that are market orders, limited orders, and cancellations. So in order to really know what is happening, we try to simulate the orders. So the main first task of Jean-Francis was to build a simulation. And the simulation will mainly consider the two kinds of orders, so the limited orders and the cancellation, because the market orders are directly executed. So just to be in case you are not too familiar with limited order book, this is a very small example taken from TSX. When you have the bid and the ask, and you have the different levels of the limited order book. The level 1 for the bid is the highest price, and for the ask is the lowest price. So in this case, we have at level 1 somebody that proposed to sell 300 to buy 300 stocks at the price 10.19, and on the ask you have somebody that wants to sell 50 stocks at the price of 10.22. So the spread between the bid and the ask is simply the difference, so in this case 0.03, and the mid price is simply the average between the best bid and the best ask, and in this case is 10 to 100 and 0.5. So when you simulate, the simplest approach is to take a discrete event simulator. So in this case, we very briefly, in the very simplest way, we consider the market opening. Here we have the limit order book update, and we see if the orders are coming. If an order is coming before the end of the trading day, we take it and we update the loop. Otherwise, if it is too late, we close the trading day, and we can analyze what has happened during the day. So the problem that in many markets is that you have very specific arrival processes. In simulation, you often consider percent processes, but in a trading market, you see that there is an effect of clustering between the orders. So we have to take this into account. So Jean-Francis has worked a lot on trying to set up a nice arrival process that combines the ticket arrival process and machine learning techniques. And briefly, if we look what is happening with the simulator, here we see what is the limit arrivals inside the spread, so the limit order arrivals. And you see that the spread is evolving through the day, and it can be large or close depending on what is the kind of orders that arrives. So when you arrive, you predict when the order is arriving, the quantity, the volume of the order, if it is a bid, if it is an ask, if it is possibly a cancellation. So all the details are taken into account in the simulator. And if you check the evolution of the mid price through the day, we see that the mid price is following this kind of curve. So in a typical simulated trading day is 8 hours and a half. And so you see the mid price evolution in this simulator. So it is simply an example. Of course, you have display a lot of different kind of stocks with different prices, with different kind of tradings, volumes, and so on. So simply to see what the simulator is capable to do, and this is able to see if a strategy is working well, if what kind of strategy should use a market maker, and so on. Another kind of problems that Jean-Francis is considering is order routings. So the main issue that with digital assets that we face is that we don't have only one market exchange. So Austin has shown a graph when you see exchanges all over the world. So the question is that if you have to take advantage of all the markets, how do you proceed? Especially since the quantity that is able that you can sell or buy on different markets are not the same, the price are not the same. So if you want to pass a large order, you have to consider the difference of the market, and it is usually beneficial to split the order between sub-orders in the different markets. So if you go to the Consilium Crypto website, you will see this recommendation system. It is really some screenshot that I took on the website, so it is, you can check by yourself with this address. And imagine that you want to split to pass the order of 10,000 SEK. This is, and you want to buy Bitcoin. Well, the Consilium Crypto website will propose to go on Coinbase, HBTC, Binance, Kraken, Bitfinex, and here you have the split of the order. So you will go to different advantage of all the markets. But to that, this is simply a routine approach. You can try to see if you don't fulfill directly your order, you can try to go over time and to try to make more advantage of the evolution of the prices and the volumes on the different markets. So this is what is Jean-Francis is working on to improve the routine approach from Consilium Crypto using dynamic programming. And this is where in the slides I have some questions. So I hope that this is still readable. You have to consider various aspects of the different market, like the fees of the market maker and market taker. You have to consider the commissions, you have to consider the liquidity, the volume of the transactions, the type of clients, if you want to do market orders or limit orders. So you have to take all these aspects into account in your strategy. So we assume that we know the transaction fees, the levels in the limit order book, the amount of the trading, and the temporal horizon of the trading. But we don't know exactly what is the future of the volume of the trading and the price in the next few minutes or next time steps. And so the algorithm has to balance these different issues because we have to go fast. We want to take the opportunities when they are there. So the problem is that we want a real-time decision approach, and we still have to try to take advantage of the different properties of the different markets. And so
2 minutes left.
Yeah, so 2 slides to make you a bit scary, I'm afraid. With some questions. So you have the volume weighted average price, that is VWAP. K is simply the time step. You have N trading platforms, and you assume to have WKI assets that are available on the exchange platform I at step K, but it is something that is random, it is unknown. You assume that you still want to buy XK at time K, and UK is the decision how to split your order between the markets. and you want to have the price improvement available on the platform I, a step K. And when your limit price is PKI, and the fees are CI. And we have the division of RKI that is given this way in the case when you want to buy assets. So it's a time over. So very briefly, this slide is a typical recursive equations from dynamic programming. So basically, you try to have the best profit at the time being, and you want to take advantage of the future. So you want to add the expectation of what will happen during the next steps. So basically, this is the current profit that you can have when you can order at the maximum WK. So you have to take the minimum between what you still have to order and the availability on the market, and you take what is happening on the future in the different markets. And so you simply update the amount of assets that you have ordered time to time. I will stop here. If there are any questions, we will take them, and probably Austin will be able to say more about the company and can say more about the problems, the mathematical problems.
Thank you very much, Austin and Fabian. For all participants, you can leave your questions in the chat. I'll start with a question. So I guess for Fabian maybe, and maybe Austin as well, whoever wants to answer. But I mean, in traditional markets, when you do optimization, sometimes when you get to actually performing what your optimal model gave you, you have some difficulties in finding the right prices, the right traders. Does that situation also translate into crypto markets, or does your model really show you exactly what you can get and exactly how you can split your trades?
Okay, so I can start, and Austin will complete the answer. So there is a lot of similarities and a lot of difference between the different kinds of markets. So the main issues that we have here is that we have different markets to consider that makes a decision more difficult. Usually in traditional exchanges, trading, you only consider one market at a time. So if you consider one market at a time, you can really use similar strategies to what you use on the traditional markets. But if you want to take advantage of the various exchange platforms that exist, and you can consider them all at the same time, then you have to make this routine approach when you split your order between the various platforms. And then here is really the difference that will happen, and more difficulties to find the right place to make the trade and the right price and the right quantity to buy or sell.
Mm-hmm.
Okay. The only thing I would add on there is just there's always going to be some kind of operational friction when you go from theory to practice. And for us, that's usually just time of flight risk, where when you send that order, there's a chance that the order book changes in that time frame. And crypto markets are still very nascent. There's not a lot of exchanges that offer co-location, and there's no kind of microwave towers or anything like that exists in traditional markets. So but there's still no doubt that this approach brings a lot of value, even with those little friction points.
Yeah, but this is also why we have to take advantage of the development in HFT, high frequency trading, because as I mentioned, for the dynamic programming strategy, it's better to have a suboptimal solution, but in real time, rather than an optimal solution, because you can miss opportunities and you can make very bad transactions if you miss opportunities.
Absolutely.
Okay. Well, thank you very much. I don't see any questions on the chat, and you answered my question. So thank you for being with us today. It was a great presentation. I won't ask anything about Fabian's last formula slide, so I'll leave that for another discussion. So thank you both for being here, and thank you all participants, and enjoy the rest of the show. Thanks.
Thank you, everyone.